So just to review how we got here, I assume most of you were around for the first presentation, but I'll summarize because it leads into the second one. I'll summarize in any case, just as a way of segueing into the focus on contrarian analysis. Basically, the argument that I made leading into a focus on contrarian analysis is that if performance is largely due to luck and advisors' performance in the real world is worse even than you'd expect on the basis of luck, then the conclusion you could draw from that, among many conclusions, but one of them is that advisors on average will be wrong. And it's not just advisors, all of us on average will be wrong at any given point. And that's really the nugget of insight behind contrarian analysis. And I want to see one way of verifying the truth of the various lessons that are articulated in the first session are true is to see if contrarian analysis is true. And secondly, I want to see if there's a way of operationalizing it in an objective way, measuring sentiment in an objective way that then can help us understand where we are in the market cycle, according to this notion that the average advisor is wrong. So that's really the segue of how we got to this second presentation. So in my interest, I guess this is just a point of sort of autobiographical interest. When I started tracking newsletters in 1980, it became very clear that short-term market timers were very bullish at market tops and very bearish at market bottoms. And this is exactly what contrarian analysis would have us expect. So at some point in the 1990s, I got to the idea that, since I have all of these advisors' portfolios in on my computers, it's a relatively straightforward thing to measure what their sentiment is and provide an objective measure of that sentiment. So the point, again, I'm just to summarize where we are, is that performance is worse than you expect on the basis of randomness. Transactions cost alone cannot explain their negative alpha. And this is a chart that I had before, which I'll just repeat because I think it's so dramatic. This shows the average performance of stocks that we buy relative to the stocks we sold. And it turns out that the stocks that we buy typically underperform over the 4-month, 1 year, and 2 year horizons relative to the stocks that we sold. So on average, we sell the stocks that we ought to buy, and we buy the stocks we ought to sell. So if you wanted one illustration of why contrarian analysis might have some insight to shed on the markets, this would be it. So the question is, can we exploit this insight? I'm afraid that contrarian analysis all too often has been used as an excuse for sloppy thinking. One example I'd like to give is years ago was the MC for a panel discussion at an investment conference where a number of newsletter editors were the panelists and I was the MC. And I kid you not, every single one of the advisors at this particular conference got up and claimed that what he or she was about to say was unique in the investment world. No one else was saying what they were saying, and therefore they must be right. Well, it turns out that they were all contradicting each other, so we knew they couldn't all be right. But nevertheless, they were trying to wrap themselves in the contrarian flag and use that as a justification for why they were right. And of course, there's no virtue in being the only person who thinks something. I mean, there are plenty of things that you can think that will be wrong. I could say that I think the Dow Jones Industrial Average is going to go to 50 on Monday. I can guarantee you it's not going to drop that much, and I can also guarantee you I'm the only person on the planet who thinks the Dow Jones might fall from 34,000 to 50 on Monday. That doesn't mean I'm right. And so you can see how contrarian analysis has this superficial veneer, but then becomes an excuse for sloppy thinking. Another example is the magazine cover indicator. Many of you probably are aware of this. In the 1970s and early 80s, it got some notoriety, and the whipping boy in the indicator, at least the way the story is told, is Business Week, because at the very top of the bull market in the early 70s, when of course you should be lightening up, they had a cover story called The Birth of Equities. And then at the market bottom, they had another market cover that was The Death of Equities. So it's just the opposite of what would have been helpful advice. So people came up with this idea that magazine covers could be a useful measure of market sentiment. Well, the problem is that there are millions of magazine covers out there, and you can always pick and choose among them and come up with quote unquote evidence, I put evidence in quotes, to support your predisposition. So if you want to claim you're a contrarian, which a lot of people seem to want to claim that they are, you can find evidence out there that everyone else, quote unquote, everyone else, disagrees with you, and on any side of any question. And I know this for a fact because I have for 40 years been on a daily basis tracking hundreds of different advisors. And I get all of their communications, and not anymore, but back in the day when people would update by telephone hotline, we'd call all their telephone hotlines and tape record them, and we'd get their faxes, and we'd look at their email updates. I mean, we would basically, our job was to keep track of everything that they were telling their clients. And every day there would be some advisors who'd be wildly bullish, and there'd be other advisors who'd be wildly bearish. And I like to think of it as, I lived in Washington for years, and during the late 90s, people called it Bill Clinton's disease, which was the disease that he agreed with the last person he talked to. And I found myself sympathetic with that disease because I'll pick up a newsletter and I'll see very cogent, documented, supported case for why the market's going to plunge. And I finish reading this, and I think I'd be a fool not to, sell out of everything in my 401k and my IRA and go to cash. Then I pick up another newsletter and, equally cogent, equally supported, equally statistically evidence-based argument for why the market is about to skyrocket. And I think coming after reading that, I'd be a fool not to mortgage the house and everything else and put it all in the market. So there's a way in which looking at too much advice can cause paralysis, because you're always agreeing with the last person that or last newsletter that you read. And so I say that only by way of pointing out that if you want to be a contrarian and you want to find people out there who disagree with you, it's not a challenge at all. You can find plenty of people who say the opposite of what you're saying. And so again, this becomes an excuse for sloppy thinking. For contrarian analysis to even possibly be of value, it's important to have an objective measure of sentiment. And that's where I think that what I have come up with over the last couple of decades can be a contribution to contrarian analysis. So I created a number of what I call the Hulbert Sentiment Indices. And in contrast to most of the other sentiment measures, and I mentioned a couple of them there earlier, my sentiment indices focus on what advisors are doing as opposed to what they are saying. And perhaps the best known example of this, of people who do the opposite of that, is Investors Intelligence, which has a very well-regarded sentiment survey. They look at investment newsletters, and every week they report investment newsletters that are in the bullish camp, in the bearish camp, or in the bullish but expecting a correction camp. So they have three camps, and they report those percentages on a weekly basis. As you know, AAII has its own investment sentiment survey, and they do the same thing. It's basically self-reported by AAII members who come to their website and report what camp they'd like to put themselves into among those three camps. But basically, that's self-reporting, and it's basically what people say they are doing. And we don't want to focus on what people say they're doing, because we have found that over the years that people will say one thing and do another. So we want to focus on their actual behavior. And that's what I think creates some uniqueness to this measure of sentiment. So we do this by calculating the average recommended exposure levels every day in the stock, gold, and bar markets. So basically, at the end of every day, we know what recommended exposure level advisors are recommending in their portfolios. You may disagree with what that average, the story that I might come up with to explain what the meaning is of that story, but disagree with that story as you might, there's still a fact of the matter. That average exposure level is a fact, and we want to focus on that fact. So to give an example, let's say there's two newsletters were included in my index, and one was 100% long and the other was 50% short. Our index would be plus 25. So it'd be plus 100 and minus 50 averaged together would come up with an average of 25%. We do that across right now we have about 100 newsletters or so in our sample, and we do this calculation across all 100 every day in the stock, gold, and bond markets, and come up with the indexes that we do. So the four indices we have one that focuses on the general stock market, and the underlying benchmark against which newsletters are reporting their exposure level is either, in most cases, it's the S&P 500, but in some cases, it's the Dow Jones Industrial Average. Basically, a large cap dominated, but overall broad market index. In addition, we also track another stock newsletter, sentiment index, that among timers that focus on the Nasdaq market in particular. And what's interesting is that there are a lot of newsletters and advisors, market timers, who have market timing models in both of these camps. And we'll find that on occasion, some of them will be bullish for the broad market, but bearish on the Nasdaq. And that's actually what we're seeing right now. I mean, the Nasdaq has been underperforming the broad market the last several weeks. The Dow and the S&P hit a new high yesterday, and the Nasdaq is still several percentage points short. So that leads them to be bearish in the current case on the Nasdaq and bullish on the broad market, or in the other cases where it's just the opposite. So we calculate sentiment indices for both of those markets in particular. Then we have another one for the gold market, and lastly, one for the domestic bond market. So I want to go through what the data, the historical data, suggests in each of these cases from the point of view of trying to test whether the conclusion from my the first presentation this morning is true. I mean, are advisors on average wrong? So we want to look at the historical data from that point of view, and then look to see what they are saying now about what the future several weeks and months might look like. So the way to interpret the sentiment indices is really standard contrarian analysis. I don't claim to have made the art of contrarian analysis any better than it was before. I'm just following standard contrarian analysis. What I think my contribution is coming up with this objective measurement of sentiment, as opposed to some other measurements that I think are a little less rigorous. So obviously, according to standard contrarian analysis, extreme bullishness is a bad sign, extreme bearishness is a good sign. So those are just perhaps the first two insights that come from contrarian analysis. One of the things that we want to focus on in particular is that stubbornly held positions are especially significant. So it'd be bad enough if there's extreme bullishness, but it's even more worrisome if that bullishness is stubbornly held. And by stubbornly held, I mean that bullishness, extreme bullishness, is adhered to in the face of market weakness. Usually what happens is that bullishness increases so in other words, advisors become more bullish as the market goes up, and they become more bearish as the market goes down. So it goes up and down in tandem. That's the usual pattern. But let's say the market goes down and they remain more bullish before, or even become more bullish than they were before. That would be an indication of stubbornly held bullishness, and is something that contrarians pay a particular attention to. And just the opposite would be the case at the bottom of a bear market. The classic example of this, at least in the history that I've been doing this, is what happened at the top of the internet bubble in 2000. You may recall that Nasdaq hit its high on March 10th of that year, and the broad market hit its high on March 24th. So focusing just on the Nasdaq from March 10th, over the next 10 days or so, the Nasdaq dropped more than 10%. So it was more than enough to satisfy the semi-official definition of a correction. So you'd think, and the normal pattern would be, is for these Nasdaq market timers to start building up some cash in the face of this correction, especially since people were speculating that maybe a bubble was forming. But in fact, contrary to that expectation, the average market timer we tracked became 20 percentage points more exposed to the stock market in the wake of that correction than they did. They became 20 percentage points more than they were at the market top. And that was something that, and I remember identifying that for some of our clients at the time, is that is definitely a dead giveaway of stubbornly held bullishness, and is not a good sign. Now, I don't want to claim that the sentiment analysis therefore predicted the bursting of the internet bubble. I'll go into this a little more later, but basically, we find that contrarian analysis and sentiment indicators in general, their greatest explanatory power is over the 1 to 3 month time horizon. So it doesn't tell you where the market will be a year hence or 2 years hence. So it doesn't really say how bad a bear market might be, for example. It will say if the market is ahead of itself or behind itself relative to its trend over a 1 to 3 month time horizon. So anyway, so I want to focus on, I'm going to have a number of charts here in a minute. Each of the following 4 charts corresponds to one of the 4 indices that we calculate. I look over the past 2 or 3 years, and each chart shows the range of highest and lowest decile readings from 2000, 20 years ago, up until the beginning date of the chart. And the reason we constructed the charts this way is I wanted to make sure that the charts are not guilty of hindsight bias. So for example, here's the stock newsletter sentiment index. The beige zones at the top and the bottom of the chart are those zones representing the top 10% and the bottom 10% of readings prior to the date of this chart, which begins in January 2019. So up until January 2019, you were in the top 10% of the distribution if the average exposure to the market was about 61% or higher. And you were in the bottom 10% of the distribution if you were at about -4%. Negative readings, by the way, let me go off on a tangent, represent an average. That means that on average, the market timers are short the market. So that's what negative readings mean. So the red line in this chart reflects the average exposure to the stock market, the Hulbert Stock Newsletter Sentiment Index. And the blue line is the Dow Jones Industrial Average. And I think if you were to inspect this chart, and there's statistical measurements which I have done to confirm this, but just by eyesight, you can see that when the red line goes up into that upper zone, the stock market struggles or declines, depending on which one you look at. And whenever the red line approaches it or gets into the bottom of in that bottom beige zone, representing the lowest decile of historical readings, the market tends to do relatively well. It's not perfect, no indicator is obviously, but I'd say that in general, looking at this chart and my econometric analyses of the data back to 2000 confirm this to be the case, is that advisors on average are wrong. Whenever they're extremely bullish, the market struggles on average. And whenever they are extremely bearish, the market tends to have a relatively good buying opportunity. So from this chart, just a first, some broad brushstrokes looking at this chart, you'd have to say that that there is statistical support for this contrarian thesis, which is what emerged from the first half of my remarks today, which is that advisors on average are wrong. Now we'll go into this a little bit more, but if you look at a very, the furthest most point, the right on the chart, which is where we are currently, you'll see that the average exposure level, the red line, is at about the 57% point. So that means the average exposure level of stock market timers in their stock trading portfolios is about 57% long. And to put that in context, that's a little bit below, but relatively close to that upper decile reading representing what I would call excessive bullishness. So we are close to, but not quite at the range of excessive bullishness, according to this chart. We'll come back to that in a minute, but I just wanted to mention that. So the next chart is the Nasdaq Newsletter Sentiment Index. So these, again, are just those newsletters and market timers that focus on the Nasdaq market in particular. Broadly similar themes, a couple of things to draw your attention to. We find that the Nasdaq market timers are, they swing for the fences more quickly. So they'll go from very bullish to very bearish very, very quickly, which is curious from a money management point of view, but is actually good news from a sentiment point of view, because you want a sentiment indicator that's very sensitive, that swings one way to one extreme to the other. And that's indeed what the sentiment index does. I'll draw your attention to a couple things in particular. Notice that if you go back to the market top in January and February of a year ago, I'm pointing to it with my mouse, so I'm not sure you get to see my mouse, but basically you'll go back there right below the 2019, and that upper decile range is the top of the market in February of last year, right before the pandemic. And you notice that at this point, especially the January reading, was not, there's well before the pandemic actually was on anyone's radar screen, really. And yet we were seeing excessive bullishness. And I point this out again, not to say that contrarian analysis had any inkling that a pandemic was going to shut down the economy. But nonetheless, the conditions were such that when something like a pandemic hits the market, there was already a lot of speculative fervor and froth in the market, such that the market was quite vulnerable to declining. And in decline it did. And notice how quickly the market timers went from the bullish camp into the excessive bearish camp. In fact, they went from about the 85th or 90th percentile of the distribution all the way down to about 5% of the distribution. And indeed, that created the preconditions for the market to turn in the strong rally that we now see. Some less spectacular rallies, but ways in which contrarian analysis can help. Notice what happened in September and October of last year. You may recall the market, especially the Nasdaq market, hit a high on the end of August, and the market pulled back. It was a 10% decline, enough to satisfy the semi-official definition of a correction. And one of the things that contrarian analysis can be helpful in doing is giving us a real-time read of whether there's the stubbornly held bullishness in the face of that correction, like what we saw at the top of the bull market, or excuse me, top of the internet bubble, or whether it's more of a temporary pullback, which would be indicated by the market timers running for the exits. And it was the latter. You can see that the market timers almost dipped down into that excessive bearish zone there in September and October. And indeed, the market started up again. So I would say that that's the condition that we're seeing now. The market, the Nasdaq market pulled back in earlier this year, and the market timers quickly ran for the exits then as well. So as long as the market timers continue to do that, that would suggest from a contrarian point of view that the rally has a little more life left into it. As I say, I don't want to say more than a little life, because it doesn't really look out more than 1 to 3 months into the future at most. So this is not telling us where we are in a major market cycle, but it tells us on a relatively short-term basis of whether the risk is particularly high or low. So let me now focus on the gold market. Again, the blue line represents the market as a whole, and the red line represents the average exposure of the market. The blue line, in this case, I use as the benchmark, the Van Eck Vectors Gold Miners ETF, GDX, which is a benchmark to an index of some of the senior gold mining stocks. We find, by the way, the reason I do this, by the way, is use it as a benchmark, is that sentiment, gold market sentiment, does a better job of predicting changes in gold mining stocks than it does to gold itself. So the way to show sentiment's impact is to focus on the gold mining stocks in particular. And again, you can see the general pattern whenever not all the time, but it is a general rule, when the red line is in the upper zone, the market struggles. We saw that especially last summer, when we saw close to the highest level we'd ever seen for the gold sentiment index, and gold has declined markedly since then. Earlier this year, especially in March and early April, the gold market dipped down into the gold sentiment index dipped down into that range of what I call excessive bearishness, and sure enough, the gold market is recovering. And just to acknowledge where we are now, you can see where the red line hits the right-hand vertical axis. We're up again at close to, but not quite, the excessive bullish zone. I'll discuss what I think that means in a little bit. And then lastly, I want to focus on the bond market. it turns out, and I not go through what I will discuss in greater detail here in a minute, but the bond market is the arena where we find that sentiment index has the least forecasting ability. And that I don't think is a surprise. I think the bond market is probably far more responsive to changes in things like Federal Reserve policy and inflation and so forth than it is to market timer sentiment. Having said that, if you were to eyeball this chart, I think you'd agree that in general, excessive bullishness is not a good sign. For example, what we saw last summer, we saw some of the highest readings ever for the bond sentiment index, and the Treasury market has declined significantly since then. Earlier this year, in fact, in March, the sentiment index reached the lowest it ever has, or close to the lowest it ever has in 20 years. And since then, you can see the Treasury market has recovered modestly. But I do want to indicate that as a matter of fact, the sentiment is probably sheds the least light of any of the market arenas that I focus on, probably sheds the least light on the bond market. So I now want to focus on how the performance of these sentiment indexes. So I'm now going to present a number of charts that show the average performance of the market following the highest and lowest decile readings. Now, those highest and lowest decile readings were represented by those beige zones at the top and the bottom of each of the previous 4 charts. So basically, the idea is every time the sentiment index would dip into the low decile, or the most bearish extreme, or into the most bullish extreme, what happened to the market in the wake of those occasions on average. So the first chart is my stock sentiment newsletter index versus the S&P 500. The green line shows the performance over the subsequent week, month, 3 months, and 6 months relative to so basically the average performance of the S&P 500 over that period of time, after every time the market dropped into the lowest decile. So in other words, when market timers became most bearish, how did the S&P 500 do on average over the subsequent week, month, 3 months, and 6 months? Whereas the red line shows the average performance over that same periods of time after rising into that upper zone representing the top 10% of bullishness, or the excessive bullishness. You'll see that the spread between the green and the red lines is widest at the 3-month horizon. And this is why we indicate that it's probably somewhere between the 1 and 3-month horizon where sentiment may have its greatest explanatory power. Notice that the spread between them actually starts to narrow after 3 months and is slightly less wide at the 6-month horizon. So this is more of a statistical support for the notion that sentiment can shed some light on where we are in the market cycle, and that the time horizon for that greatest explanatory power appears to be in the 1 to 3 month horizon. The next chart does this, it shows the S&P 500 and the Russell 2000. So the Russell 2000 you can see the green line and the red line is the same as what I had in the previous chart, but what I've added is the purple line and the green line, which represents the performance of the Russell 2000, which reflects the smaller and mid-cap regions of the market. And first principles would lead us to think that those are the stocks that are most susceptible to market timer sentiment, because they are the ones that large institutions have the least ownership percentage of. And sure enough, there is a greater spread between the purple line and the green line. So in other words, for the Russell 2000, in other words, excessive bullishness and excessive bearishness mean more when you're investing in the small cap and mid cap range than you do in the large cap stocks. And again, you'd see, I think, perhaps the greatest explanatory power is at the 3-month horizon, though it also is quite robust at the 6-month horizon. Okay, this is now the Nasdaq Sentiment Index, and I'm now comparing it to performance in the Nasdaq Composite. And What's interesting here is that by 6 months out, there is no difference in the performance of the Nasdaq Composite relative to entering the market when there's excessive bullishness or excessive bearishness. And indeed, the difference between 1 and 3 month horizons is almost non-existent, which is to say that when you're dealing with Nasdaq sentiment, the expected market performance, as expected according to Contrarian analysis, is largely spent, I guess is the word to say, by 1 month out. And that's another way of saying is that this Nasdaq market more quickly responds to extreme sentiment, both extreme bullishness and extreme bearishness. It responds more quickly than the S&P 500 in the broad market. And I think that stands to reason. We would probably expect something similar. Now we go to the gold market. And again, same sort of thing, but now we're focusing on the performance of the GDX over the same periods of time, week, month, 3 months, and 6 months. The greatest explanatory power here is yet again at the 3 month horizon. But what I want to really focus your attention on is the spread. Notice that it's now between over 2% for the green line and down near close to -7% for the red line. So the spread between entering the market when there is excessive bullishness and excessive bearishness is far wider in the gold market than it is in the stock market. So just to go back to the previous charts, let's look at so here, if we go all the way back to the first chart, notice that at the 3 month horizon, it's a spread of about 4 percentage points between entering the market with excessive bullishness and excessive bearishness. So basically, there's a 4 percentage point spread, whereas when we get down to the gold market, we see perhaps almost a 10 percentage point spread between entering the gold market when conditions are favorable or unfavorable from the point of view of excessive sentiment. And the reason I want to point that out is that also stands to reason. Even though stock valuations are a very is as much of an art as a science, there is a science behind stock valuations. They have to have some relationship to earnings and book value and cash flow and so forth. Whereas in the gold market, it's harder to come up with a fundamental valuation model for gold. Indeed, there are a number of researchers that have tried to come up with any valuation ratio for gold that has as much explanatory power for gold as any of those other ratios do for the stock market. And they have yet to come up with any that have as much explanatory power. So in a world in which fundamental analysis, any valuation indicator, will have relatively little explanatory power to play, that is a playing field in which sentiment should have an outsized influence. And sure enough, it does. And we see that by the greater spread between these two lines at the 3 month horizon. So that's exactly what we'd expect. And I use this as an example and illustration of the fundamental truth of contrarian analysis. In that very arena where you'd expect sentiment to have the greatest explanatory power, it does. Lastly, we go to the Treasury market. And as I indicated earlier, sentiment has the least explanatory power of any of my 4 arenas in the bond market, as I think would be expected. Notice that now there is a spread that keeps widening even up to the 6 month horizon, but it's relatively modest. At the 3 month horizon, notice that it's only about 20 basis points. And at the 6 month horizon, it's only about 100 basis points or 1 percentage point. So what I mean to say about that is that contrarian analysis is not worthless in the bond market, but it is going to tell you less, shed less light than it would in the other markets, and especially relative to what it would tell you in the gold market. So where do we stand now? So here are the specific numbers. You saw those in the charts earlier, the graphic representation of them. My stock newsletter sentiment index, these are as of last night's close. We update this every day at around 5:30 Eastern. So right now we're at about 56% exposure to the stock market among the market timers that are part of my stock newsletter sentiment index. Let me go off on a tangent here. By the way, these numbers, these percentage exposure levels, there's no expectation that they should add up to 100. These are, so think about that 55.97% is the average exposure to the market in a equity trading portfolio. So it's relative to cash. So basically, the 55.97% implies that these market timers are suggesting that in your equity trading portfolio, you would have 44% in cash, regardless of what you might do in the gold or the bond arena. These are basically independent observations. So in the Nasdaq market, you're seeing the relatively less bullishness, as we were indicating earlier. 40% is the average exposure to the market, and that's higher than 56.6% of all readings since 2000. So basically, the Nasdaq timers are very close to the middle of the range. They're neither excessively bullish nor excessively bearish, and they're very neutral. Whereas the stock timers, not perhaps surprising given the fact that the Dow and the S&P have just hit new all-time highs again, is they're higher than 79.7% of all readings since 2000. That's not quite to that 90% threshold that I have used as a delineation of what would be excessive bullishness, but they're much closer. The gold newsletter sentiment index is at 53.23%, which means that that's the average amount of a gold trading portfolio that they're recommending their clients have invested in gold and gold stocks. And that's higher than 80% of all readings since 2000. So it's even slightly more towards the bullish end of the spectrum than the stock newsletter sentiment index. And lastly, the bond newsletter sentiment index is at 21.15%, which is higher than 16.9% of all readings since 2000. So that of any of the sentiment indexes that are close to the excessive bearish zone, the bond sentiment index would indicate that. And that would suggest that, so if you were to ask me the message of these indices, which one is indicating the greatest likelihood of a rally in the next 1 to 3 months, I'd say the bond market is the arena that I'd bet will see a rally. And of the arenas where I'd see the greatest chance of either a give and take market or an actual decline, I'd say the gold market is the one where there's the greatest expectation of a pullback, followed very quickly, not very much behind it, by the broad market as well. So that's my read of that. So then you'll get a copy of these overheads, but this is how you can email me for more information. And then, as Lynn mentioned at the beginning, I have my periodic columns that I write. I write for 5 different websites at the moment. You can see my periodic columns. Most of my columns appear at MarketWatch, but occasionally once a month at Barron's, once a month at the Wall Street Journal, once every 2 weeks at the Street, and once every week, 2 weeks at Callaway Climate Insights. So I'm going to end there. I can talk more, but let's see if there's any questions that have emerged in the meantime.
There was one question actually referring to the first presentation. Someone is wondering whether your example with Buffett or with Graham was meant for Buffett since he owns Geico. I think they're just asking if you mixed up the person you were talking about.
Well, no, I mean, I didn't mix it up. Graham is the person whose entire lifetime track record is in one sense dependent on Geico's performance. And so, and Graham writes about that at the end of his book, The Intelligent Investor. And I believe it's the 3rd edition where he has this postscript where he talks about that. And so email me, the email address that's on the screen if you can't find it, and I can give you the exact citation. But I'm definitely referring to Ben Graham. Now, it is true that Warren Buffett has a substantial position in Geico, and it's built up over time, but that's not a surprise because Buffett basically was a successor to much of the, in fact, he got his start as working with Benjamin Graham and considers Ben Graham his mentor. And so he says he owes much of his investment approach to what Ben Graham recommended. So I think that it's not a big surprise that Warren Buffett would have a substantial Geico position, but the anecdote about luck playing such a huge role in performance was referring to Ben Graham.
Good. There was a second question. Why miners and not gold itself? I think probably referring to the fact that you said that the correlation with the indicator was
right. Yeah, but it's worth
stronger.
going into that. You're absolutely right. So if you just run a regression on my sentiment index in gold and the subsequent performance in gold mining stocks, and you could also do it among junior gold mining stocks. The GDXJ is another ETF which looks at junior gold miners. You find that the greatest explanatory power is with the junior gold miners. And then the next most explanatory power is the GDX, which is what I showed here. And the least is with gold itself. And I think that stands to reason. A gold mining stock is going to be a leveraged play on gold. And the gold junior stocks are going to be the ones where you'd expect that sentiment plays the greatest amount of explanatory power. So I think it stands to reason, even if you disagree, and I welcome any disagreement, please disagree with me, but the fundamental reality is that my sentiment index has relatively little explanatory power to subsequent movements in the gold bullion itself, but does have statistically significant ability to predict changes in gold mining stocks, and especially in junior gold mining stocks.
Okay, one more, and I assume this refers to something you've written. I don't know, but here's the question. Do you think ARK funds are still high risk? Question mark.
Yeah, that you're referring to a column I wrote about a month ago on the MarketWatch website. If you go to the MarketWatch website and just search on my name, you'll see a scroll through of columns that I've written. I write about once a day. I'll post something. And about a month ago, I don't remember the exact date, but you can scroll through and find it. It is a column on the ARK funds, and this won't come as a big surprise because what I was saying earlier about double momentum and on other strategies, I don't think that strategy is going to beat the market over time. And one of the analyses I applied in my column was to go through a number of risk adjustments in analyzing its past record, and found that its past record is a lot less impressive once you adjust for risk. And there's no reason for me to expect that the risk is any less now than it was a month ago, to answer your specific question. In fact, as I was mentioning earlier, a portfolio or strategy's riskiness is something that's highly persistent. Now, it's possible that Cathie Wood could decide to start pursuing, a very conservative dividend yielding, approach with high quality stocks or something. I'm trying to think of what would be the opposite of what she's doing. In which case, of course, her relative riskiness would drop back quite a bit. But I don't think there's any chance that she would do that. And so I think, it's a good expectation that risk will remain very high with her. So. And then this reason to mention that is that, as I was mentioning earlier with that analysis that Fama and French did in that Financial Analyst Journal article, is that if you were to look at the role volatility plays, is that even if the future is like the past, so in which case you might say, even if Cathie Wood's ability to pick stocks is just as good in the future as the past, the excessive volatility that is evident in her approach means it's still a good likelihood she could underperform the market, having for no other reason than volatility alone. Volatility, after all, is just another way of saying that luck is going to play a huge role in short-term performance. So it wouldn't mean, so the way of putting this in a positive light is to say, even if she underperforms for the next year or two, doesn't mean she's lost her touch. So if that were to happen, I'd be writing a column saying, don't conclude that she's lost her touch just because she's underperformed the market. But on the other hand, the negative way of putting that is that because of that excessive volatility, you have to incur the significant probability that you're going to underperform the market in the future, even if the future is as good as the past.
Okay, one more, let's see, there's three more questions listed here. First one is, based on your presentation, why analyze the past? Best approach to establish what is our outlook for the future, like Wayne Gretzky said, find the best manager that matches that outlook over the intermediate term.
Right. Well, I'm sympathetic with that point of view. I mean, I just want to then, but just pause and really realize how, how fundamental a change in our outlook must be required if we take seriously that we shouldn't look at the past. Because if we shouldn't look at the past, then all bets are off. It doesn't mean we should do one thing over another. I mean, why should we decide that going with a good manager is the way to go? Because that manager is good, presumably because he or she has known how to, has a good track record at dealing with how to manage a company. How else would we know that that person is a good manager? Because your question was, why not pick a good manager? Well, how do we know who a good manager is unless we look at the past? And so I'm not so completely, willing to throw the past out, as you might suggest, but I'm just willing to emphasize that the past tells us relatively little. I mean, to go back to that example of the history back to 1793, there are 3 or 4 major periods or regimes is the word I used, where the relationship of the stocks to the bond market and to the economy as a whole were profoundly different. So, even if we were to say the future is like the past, we'd have to decide, well, what past is the future like? And, the problem with all of this, and this is something I didn't talk about, but it's worth emphasizing here, is that there's huge survivorship bias in everything we do. And so we don't focus on those who fail because we've forgotten about them. So, how many other Benjamin Grahams existed in the 40s to the 1970s who could have had just as good of a record, but they invested in the equivalent of Geico, but that company went bankrupt. And so they underperformed the market and we never heard of them again. So there's survivorship bias even in the fact that we focus on Benjamin Graham. And how many other Benjamin Grahams out there that we've never heard of? And we always extol the virtues of success, and it's almost impossible for us not to focus on them. But so basically, if we step back from the statistics and just look at general and broad brushstrokes from what I'm trying to say, is that if we take seriously the role of luck in investment performance, that all bets are off. And I don't say that with glee or happiness. It means that the future is profoundly unknowable, and we just have to deal with that fact. I mean, I remember the book that got the Nobel Prize years ago in literature is called The Unbearable Lightness of Being. And I often think there should be the equivalent of investing. It's the unbearable lightness of investing. In that book that won the Nobel Prize, the main character didn't know which of 2 women that he wanted, he was thinking of marrying. And he mused, he said, I'd like to have 2 parallel lives, marry each of the women separately in each life, and at the end of the life, see which was the better life, and then come back and do that decision. Well, of course, we'd all love to be able to know what the future is like, whether it's in our marriages or in our investments or in our careers, but we can't. We somehow figure out how to deal with profound uncertainty in other aspects of our life. And I think we need to deal with that profound uncertainty here. And one way of looking at what we do in the investment arena is we try to kid ourselves that the world isn't as uncertain as it really is. And I just so basically one headline from what I'm saying in all of this is to appreciate how much uncertainty and randomness there is in all of what we do. I'm sorry that that's depressing, but that's really the conclusion that I come to.
Okay, have you considered tying together all 4 indices in a way to find more predictability or explain more?
I have not done that. The only two indices I've looked at in tandem are the stock newsletter sentiment index and the Nasdaq newsletter sentiment index. Both of them focus on aspects of the stock market, so it makes a certain amount of sense to look at them in tandem. So I have looked at constructing a sentiment index that just looks at the average of those two, and it does have some interesting statistical properties. So another way of putting that is that it would be particularly concerning when both indices are suggesting that there is excessive bullishness. Right now, for example, the stock index is indicating we're close, relatively close to excessive bullishness, but the Nasdaq is right in the middle of the distribution, which is to suggest that there's not quite the level of excessive bullishness that might otherwise be the conclusion we would draw. So that's the way in which you would use those two indicators together. But I've not tried to look at all four, and I sort of have my doubt that you would get much. But it's always an empirical question, and that'd be something that'd be worth looking at.
Okay. Have you looked at the NAAIM, National Association of Active Investors Managers Exposure Index question? If so, how does it compare with your market index? They look similar.
Yeah, so I have looked at that. I've looked at, quite a few different sentiment indices, including the AAIIs and the Investors Intelligence and so forth. And they all have some, they all have some value. And so, I'd never say one should look at only one indicator alone. I think different ones have different, different virtues. The NAAIM's index is relatively infrequently updated, as I recall. I can't remember exactly the periodicity of it, but there is, it's relatively infrequent and there's somewhat of a time lag. Whereas my index, again, not to pat myself too much on the back, but it's updated every day. And I think that that gives it some sort of advantage or leg up on some of those other indices. It's interesting, if you go back to 1980s, and look at sentiment then, it turns out that people, that the market did not work off conditions of excessive bullishness or bearishness as quickly as it does now. In other words, a way of putting a sort of a narrative on that, it's like time has sped up. So we can go today from conditions of excessive bullishness to excessive bearishness within a month or two. Whereas it would take many months, if not a year or two, back in the early 1980s. Now, these are broad brushstrokes, but I think in general that the world has sped up. And so I think there is a particular virtue for a sentiment index that's updated more frequently. We find that there's one reason some of our subscribers, pay us to send out the sentiment index on a daily basis. And some pay us for weekly updates. And it's interesting, the different experience of the subscribers who get weekly versus daily updates, because we might have an excessive bullish reading on Tuesday, let's say, and by the following Monday, which is when my weekly updates go out, that condition has largely worked off. And I would have said that a weekly update was far more than is sufficient to catch readings of excessive bullishness or bearishness in decades past, but I'm not so sure now that it's sufficient.
Are there any other questions? Celia, do you have a question?
I don't see other questions at this point.
Well, let me just quickly run through the charts again, just to show where we stand as a way of
can't
putting. So you can see there, the stock sentiment index, we're closer to the excessive bullishness zone up here.
The 60.
And then the Nasdaq sentiment index, again, we're closer to the middle of the distribution. So again, if you were to try to draw a conclusion from that, you'd say that the S&P 500 is more vulnerable to a pullback at this point than the Nasdaq. But obviously both, if there were a major pullback, would both fall back. But relative to the two of each other, you'd say that that's the case. The gold newsletter index, we see close again to the excessive bullishness zone, though we're not quite there yet. So conditions in the gold market are nowhere near as attractive as they were even a month ago. And in the bond market, we've been in excessive bearishness among the market timers. We've come out of that, but we're still closer to the excessive bearish zone, which is to suggest that perhaps the sentiment wins will be in the, at the back of the bond market in the next week, couple weeks or so. But I think I'll end it there. You see there on the screen email and my website. Please contact me if you have any questions. But in the meantime, thanks so much for your good attention this morning.